So when the market has made a dramatic move and it's supported by volatility also moving dramatically, like this E-mini S&P trade, you can see that there had been a sharp drop. It was just after the market opened, and I just put an order on to sell. Now, the reason I put an order on to sell was because I had seen the bigger picture take out the support levels I'd been monitoring, and an opportunity to sell here came in because of that 3-minute bar pausing, having a bigger upper shadow, and the midpoint of it being a great, safer entry. So you can see I got short, and a 15-second chart here showed that it formed a little price high as well, those blue dashed lines. So I started moving around my black alert lines to help me monitor what was going to happen. Now, that wasn't to move my stop or change my trade strategy. It was just to monitor. So you can see here, I got out of a first contract, so I had 2 on, exited 1, and then I moved the other stop to max 2 points risk. By doing this, I create a neutral position. Now, whether I get stopped out or not, I don't care, because the worst thing that can happen is I'm even on the trade. But I still have 1 contract short to be able to ride a potential move lower. Now, I will be editing this video in this set that you're watching so that I take out some of the really boring quiet times where I was watching paint dry. Just know that this consolidation persisted for a bit, and in a moment you'll see when it started to break. So here I fast forwarded the chart, cut away some time to when it started breaking lower. I was still short that contract, and you can see I started moving my alert lines. This is when my trade management began. I first got my exit order that sort of just sits out there out of the way. I did that a couple times, but the most important thing I want you to focus on is how I trailed the stop down. Look, when the market gives you a strong move, whether it's up or down, it really pays to just let the market tell you when it's done moving. We can make all kinds of judgments here, right? I could have gotten out here and been like, oh, well, it's going to be a volatile market. We're not going to push lower than 579.925, but I didn't do any of that. I used the middle of that 3-minute support to trail my stop, as you just saw, so that I wouldn't give back too much on the trade. But after that, I began just trailing based on 15-second price highs being lower and 15-second 2-bar highs. That's a method I teach in my Gann Trading Patterns course. So again, a lot of this remaining video is me managing the trade, and I'll show you the important chunks along the way. So having identified a lower price high in the 15-second chart, trailed the stop down here again. Also referenced the 60-minute chart, the daily chart. I wanted to get my bearings of where I was in the bigger picture time frame. I did have an expectation of where this whole shakeout might end up, but I was just letting the 15-second chart tell me where it wanted to go and moving the stops accordingly. So now you can see the worst case scenario on that second contract, I will have locked in $325 of profit. And all of these flashing alerts on the bottom right are from my 15-second chart where I put alert lines to flash continuously. I do that on purpose so that they get my attention because I'm using them actively for management. So now you can see I located 2-bar high, and I went back to the matrix and lowered my stop again. And this went on and on and on. You can see it came into some 60-minute support here. Nothing major, just a support at 5788, but still I used the 15-second chart to lower my alert and change the stop order accordingly. And in the beginning of this move, it ended up being that I was trailing the stop down like a point at a time. That's just the way the action was shaking out. You might be wondering, but Hema, the RSI power zones are getting really oversold. Look on the 15-second chart and the 3-minute chart. Yes, a weak market will push the bear support power zone quickly, and guess what? It can keep pushing. That's not a stop point for a bear market. It's just a likely area where if it's going to turn back up, it would do so in that zone. So don't let getting to the bear zone of support be your reason to exit if the market's telling you it's still weak. All right, there was another push lower. So time to trail the stop again, this time on an actual price high, not just a 2-bar high. The way I looked at it, if I wasn't being prompted to get stopped out of my short, why would I go long? Okay, the market might find a footing, but I'd want it to really show it to me under such sharp falling conditions. Now here, when it kept going lower, my stop was where it needed to be. It was 1 tick above the most recent high, and I just kept it there. Then I started using the 2-bar highs again to make sure I was squeezing as much profit out of this move as I possibly could when the time came to exit. All right, now the stop was exited on a trailing stop. And here's the final screen capture of what that exact trade looked like. So if you found value in this video, please go ahead and give me a like down below. Subscribe to my channel if you haven't already. Drop a comment, share your insights. And if you want to see more of this on a regular basis, join my S&P Edge Pro, where we trade the E-mini S&P every Tuesday, and I provide various research reports that guide trading all the other days of the week. All right, catch you next time.